Welcome everyone and good morning. Welcome again to Columbia University's 19th Annual Social Enterprise Conference Capital for Good digital event series during this pandemic. This session is also part of something called the Phillips Pathway for Inclusive Leadership, the PPIL program, which is new for MBA students at Columbia, which focuses on leadership and managing diversity, equity, and inclusion across industries. So for all of the Columbia MBA students who are in the audience today, you should please virtually check in using the link that will be shared in the chat box below. This Capital for Good conference showcases social impact leaders who are deploying capital to generate sustainable solutions to global systemic challenges. So we hope today, this event and the upcoming events in this series serve as a terrific forum for creating, interesting conversations and exchange of new ideas, best practices from terrific mission-driven businesses and social impact leaders drawn from the Columbia University network and beyond. So thank you so much for joining us. I wanted to share a quick slide for those of you who have joined us before. You would have seen this particular slide before, but it's something that I think is fairly common if you're working in the social impact industry. But this is how we think of capital for good at Columbia Business School and the spectrum of capital that this conference series and that a lot of our programming covers. Everything from, the sort of ESG or socially responsible investing through to philanthropy. And the way we think about this is that when we're tackling social and environmental problems, given how hard these problems are, you need every single tool at your disposal. And we need more of all of it, not just, one tool. Just as you're building a building, you use the thing that's most appropriate given the problem at hand. So I just wanted to put that out there as something that kind of can help frame the upcoming discussions that we're going to have today, but that there are other sessions today that, and in this series that cover other aspects of this spectrum of capital. So with that, I'm going to stop the share and go back to introductions. Today we have some terrific panel discussions covering microfinance and later on healthcare. And then there's an opportunity to do some virtual networking at a different platform that we hope you'll join us, and we hope to see you all there. So with that, I'd like to hand over the stage to one of our terrific conference organizers, Shreyas Pandit, who helped us pull all these ideas together for our first discussion. Shreyas.
Excellent. Thanks, Sandra. Thank you all for joining us here today. So my name is Shreyas Pandit. I'm a first-year student at Columbia Business School and the panel organizer for this session. So I'm pleased to introduce the esteemed panel today. So first up, we have Diane LuTran. So Diane is she is an EMBA Global candidate at Columbia Business School, London Business School, and the University of Hong Kong. So Diane was formerly the digital finance specialist at the International Finance Corporation in the World Bank, where she provided investment and advisory services focused on expanding financial inclusion, access to information technology, and workforce development for MSMEs and women-led businesses. So Diane works across financial services, technology, and international economic development practice areas for East Asia, Pacific, and Africa. And then we have Jennifer Pryce. So she is a Columbia Business School graduate. She is currently president and CEO of Calvert Impact Capital. So for 25 years, Calvert has strived to make markets work for more people more often by investing in communities overlooked by traditional finance. Jen began her career in the Peace Corps. She also worked at Neuberger Berman and on the investment banking team at Morgan Stanley's London office, and also at a national community development financial institution called a Non-Profit Finance Fund, which invested in capital in communities. And then we have Brad Swanson, again, a business school graduate, currently partner at Developing World Markets. So Brad manages private equity investments in global emerging markets as the partner at Developing World Markets, which is a socially responsible fund management firm. He's also held other senior positions in international finance, working in more than 60 countries in total. And last but not least, we have David Delser, a business school graduate of 08. He's currently Chair and Chief Innovation Officer at BFA Global, Director of the FinnSalud Project as well. So David brings his world-class high-tech skills in growing areas of BFA Global to expand the company vision. He supports and promotes tech enablement in the financial sector and reaches beyond the financial sector to other tech-related businesses and social investors. And David is also the founder and chairman of FrogTech. Now, the FrogTech is a business that provides app-based technology to enable small retailers in developing countries with better business tools. So now I'll hand it over to David, our panel moderator.
Thank you, Shiraz, and thank you everybody for joining the panel as audience. And of course, thank you to the panelists for lending us their time and their expertise. And as you've seen through the introductions, we have a really striking, really amazing panel with three alumni, or two alumni and a very soon to be alumna that represent organizations that have played a central role really in the funding of the microfinance industry, pretty much since its inception, I don't know, 30 years ago or so. So in this panel, as we were preparing it, our goal was really to review the trajectory of the industry quickly, take a bit of stock of where it is right now, as COVID is affecting it just like it's affecting everything else, and then look towards the future to see where might it go, right? And including ways for students or for professionals that want to enter the industry to do so, right? So we'll touch on three sort of main trends that are all very massive. One is globalization, another one is digitization or technification, and the third one will be diversification, because microfinance started really as microcredit, but now inclusive finance has the whole suite of financial products in it. And of course, at the end, then we'll touch more on that question of, if you're a student and you're excited about this field, the panel may be even more excited, hopefully, how might you be able to approach this industry? So we're going to start briefly talking a little bit about one of the pioneers and leaders in the industry. It's an organization called Brac, whose trajectory has really run parallel to that of the industry overall. And I don't know, I suppose not everybody in the audience is equally familiar with the organization. So just as a brief intro, it is the largest nonprofit or NGO conglomerate in the world by number of employees, which is around 90,000 in, I think, 11 countries. It's based out of Bangladesh, was founded in the 70s, and really started as a microfinance program, then it's diversified into many other areas. And just to give you a sense of the size of the organization, there in 2018, the latest year I could find data for, they doled out $4 billion in loans with a reported repayment rate of 98%. So they're lending quite well and quite big amounts. So Jen, in our prepping call, you were telling us that Calvert played a very important financial role in helping Brac expand beyond Bangladesh. Could you share with the audience how that expansion happened, and how do you think it might have influenced the broader industry?
Yeah, David, thank you for that wonderful introduction to Brac and for all of us. And just stepping back a moment, I just wanted to share with the audience Calvert Impact Capital's perspective, how we engage with microfinance, and then move forward into your question. Calvert Impact Capital has been around about 3 decades, so almost not as long as the microfinance sector, but our roots are very closely tied to microfinance. We as an organization offer products and services to the capital markets, so investor capital can reach communities. And within that, our early roots were in microfinance and community development financial institution lending. So really financial inclusion, providing capital to individuals and businesses that were overlooked by traditional resources. And in microfinance in particular, as I just said, we have a long and deep history. If you fast forward to today, where we still engage with microfinance is directly in microfinance institutions. We invest in microfinance networks. So these are entities that have a group of MFIs that they own and sometimes finance, and then microfinance vehicles, so funds and structure funds that then on-lend to microfinance institutions. So there's a lot of entry points into engaging capital into microfinance institutions, to reaching people and communities, and that's 3 ways that we reach, our capital reaches individuals and businesses. Microfinance too, we've been in it 30 years and it has grown and evolved enormously. In 2018, I looked up this number last night, it was about $100 billion industry. So if you size that, it's bigger than the state of New Hampshire, which has an economy of about 80 billion, but smaller than Nebraska, which is about an economy of 120 billion. It's bigger than Ecuador, that has an economy of about 84 billion, but smaller than Bangladesh, that has an economy of about 115 billion. So this is sizable. This is a market that has grown and evolved. And as you indicated, Debbie, we'll get into more of that, myself, Brad, and Diane, as the day goes on. And I think Brac is a good place to start that conversation. As you mentioned, it's 40 years old, founded in 1972. And Calvert Impact Capital's direct involvement came in about 2006, when Brac was looking to expand. And I think one of the great taking points from their expansion, which was to Africa, where they saw a need to alleviate poverty in the mind of their mission and bring their work that they have been doing in Bangladesh into the continent of Africa, is that this is a group in microfinance in general that works very much with community need in mind. And with that, thinking about community, the needs of community, a lot of the innovation I think we'll talk about today is really, advancing the needs of communities. As communities' needs evolve, microfinance has been a great partner over the decades in meeting those needs and accelerating access to capital and other services for communities that are left behind. And in this case, in 2006, what Brac saw was a continent and microfinance institutions that they wanted to provide capital to, and in particular in local currency, that would have been a challenge for many of these microfinance institutions, as they were borrowing in dollars or even euros, but lending in their local currency. So they, as institutions, were holding a lot of foreign currency risk. So they created a fund to reach South Sudan, Tanzania, and Uganda. We were one of the capital providers of that fund. They had challenges, to be very honest. South Sudan conflict struck, so they fell out as a target for investment and capital, providing capital. And the currency fluctuations in the other 2 countries were more erratic than had thought. And so the sustainability of the fund was challenged. But I think, overall this shows how, again, microfinance has always been pushing the envelope, always trying to move where there is gaps, where there is challenges in really meeting in a reasonable way the needs of communities. And I think, we'll move from that place as we have this conversation in other examples. But I'll throw it back to you for now, David.
Thanks, Jen, for that overview. Shifting to you, Diane. The IFC also made an investment, not in Brac's expansion globally, but more in Bcash, which is the mobile money provider that is owned by Brac. So basically a move not global, but into more tech. Can you tell us a bit more about the rationale for that investment, how it's worked out over the years, and maybe perhaps before, how does the IFC engages with microfinance?
Thank you, everyone.
Yes.
Okay. Thank you, everyone, for being here, and the panelists, all the speakers. So I'll provide a case example from the IFC World Bank perspective of our engagement with Bcash. Bcash is actually a very successful MFI story to date. Bcash is actually Bengali for prosperity. And this company, this case, really started about 10 years ago with 2 Bangladesh American brothers, who are infamously named now as Kadar brothers. So they basically saw a really big need in Bangladesh, a country of over 160 million people. 60% of them are unbanked. They don't have formal bank accounts or conventional banking services. And at the same time, they saw that cell phones were actually very ubiquitous across Bangladesh. and that the emerging markets of, let's say, Kenya and Philippines were already launching very successful mobile financial services. So they decided in Bangladesh that they needed to basically partner with a local partner there. And so they engaged with Brac, the founder, Fazida Bean. And so by 2011, they established a joint venture with Money in Motion, their LLC, and Brac Bank to create this mobile transformation journey to reach the most poor markets, the destitute markets of the country. The idea came at a very favorable time. During that time, the government of Bangladesh was really looking for alternatives to expand financial access to low-income portions of the population, just because conventional banking was very expensive and people just couldn't get access to brick and mortar banks. So bCash went on to work with the Brac Bank, the central bank, and the Bill and Melinda Gates Foundation. And by 2012, they launched, and they first started with a P2P financial lending product, as well as savings account. And in 6 months, they were able to grow their user base from 2 million to 10 million. So we saw, from IFC's perspective, we saw a tremendous demand and growth potential for bCash. And at the same time, they saw basically new markets and they wanted to expand their financial products. And this is where IFC began their engagement. So they expanded their financial products into social payments, international remittances. And IFC injected a 10 million equity funding, as well as knowledge and global expertise in the merchant payment supplier space. And so just to go back to your question, what's the rationale for IFC? I'd say the three main rationale for IFC in their investment was first, seeing these Qatar brothers and their successful management style and their leadership in expanding off technology in emerging markets. IFC had an existing partnership clientele with Brac Bank. And third, the government regulations and the regulatory frameworks for mobile financial services in Bangladesh really pushed the envelope for IFC to make this investment. So fast forward from 10 million to where they started, or 2 million to where they started. Now they have over 30 million people who use bCash, which is really amazing. They have over 50,000 merchant suppliers. And starting with two brothers, basically, they grew their company into over 1,000 employees. So this has been a very successful case study for IFC.
Wow, great. We need more success stories like that. So thanks a lot for sharing that journey. Brad, shifting now to you, you've also been investing in the microfinance industry now as part of DWM for a number of, at least a couple of decades or so. So we've now talked about how Brac expanded globally, how Brac also expanded technologically as two big trends. How would you perhaps summarize the state of the microfinance industry, say a year ago, before COVID hit, right? Where, were there other trends that you were seeing that were apparent? What would your thoughts be around that?
Sure. Well, thanks for the question, David. And I think it's important to note that what we do at Developing World Markets is we try to deliver commercial returns for our investors as well as social returns. So I have to take a very conservative approach to investing in the microfinance industry to ensure that we are keeping on the commercial scale of our returns, because we're serving mainly institutional investors. And just to give you a sense of scale, we've put out over $1 billion in equity and debt investments in microfinance institutions, mainly over the last 15 years or so. I think the most key aspect to understand from my perspective anyway, when looking at the microfinance industry and the shocks that it is experiencing now and will in the future and has in the past, is to understand the underlying robustness and resiliency of the businesses that microfinance supports. And for this, I want to tell you a little bit of a story going back to 2008, 2009, when as fund managers, this was the first time we had gone through a global economic downturn. We all remember the financial crisis of that time, and we were scared to death how our microfinance investments were going to respond to this crisis. And sure enough, like every other financial institution, there was a downturn for a while. There was a fall off in growth. There was a decline in portfolio quality. It was very scary. But unlike the formal banking sector, within a very short space of time, our client companies came back and resumed their growth. And the graphs were just amazing to see just what a small blip it was in microfinance, where it was a huge dip for the rest of the world. And we asked ourselves, why is that so? Why can these institutions, which are very small, which have a lot of foreign currency exposure, which are lending to poor people, after all, how can they do so well? And I think the answer is actually very simple. When you look at what happens in a financial crisis, you see those companies which deal in non-essential goods, which deal in capital intensivity, which are more exposed to the top end of the economy, yes, do very poorly. But when you look at businesses of the scale that we're funding indirectly through the MFIs that are doing basic human needs kinds of businesses, that lasts day in, day out. I mean, obviously it's not perfect. There are stresses. And if we talk about COVID, I'll be happy to give you some insights into how our companies are doing under COVID, but they will come out, the vast majority of them, okay in the end, because there is this underlying robustness in the day-to-day economic activity that microfinance is supporting.
Thank you. That's very well put. Thanks so much. Jen, I'll shift over to you because I think this question is a perfect segue for Brad's take. During the prep call, you were in gesture paraphrasing a very famous CBS alumnus, right? About Warren Buffett, essentially, who said once the tide recedes, you see who was swimming naked and who wasn't. What is your take? Would you agree with Brad, or are we going to see a lot of swimsuits, or will we not? Right? What's your take?
Right. You know, it's nice to follow Brad's comments, and like Brad, we have a very global and diversified portfolio, so we reach over 100 countries and see a lot. And I would absolutely agree that, like in past challenging markets, these institutions are showing resilience and also decorrelation with the markets. And so we haven't seen, the actual audits or financial statements of these periods of time yet, but the early indications that we see is that there is no lack of intent for people to repay these loans. They may have a lack of liquidity at this moment, but no lack of intent. And so the robustness, the underlying assets we see as very strong. Where we do see, different trends, and I think this is just, personal opinion and a conversation, is where climate change has intersected with the pandemic and has really created a much different outcome for a community, and this, as we all know, I think now is not going to be a one-off trend, where climate change really impacts communities that are poor and under-resourced. They are the most vulnerable. And where we see those interactions, whether it's floods or hurricanes taking communities out completely, there is challenges with a portfolio of borrowers. And so I just leave that as a comment that this is a bigger trend that is at times, I think, getting overshadowed by these kind of intermediate events like the pandemic or like the downturn in 2008. But it is an increasing trend that is not necessarily time bound. And how does that interplay with what we're seeing and what the future will be like?
I hear you, and it's interesting to think about it this way, like those low-income communities could do just fine when Wall Street was collapsing in 2008. They're probably, as you're saying, I'm very keen to hear your take, Brad. They're probably going to survive. The resilience is going to be sufficient to weather this COVID crisis, but maybe not the climate change crisis, right? That may be too much for them. But I think that's fascinating, but probably a topic for another panel. But Brad, you were inviting us with these insights about how the COVID pandemic is affecting your portfolio and perhaps the broader industry. That would be very interesting to hear what you're seeing as trends.
Sure, happy to. Coincidentally, already this morning, I've been on board meetings for one of our Indian MFIs and one of our Latin American MFIs. And so I have the current information how both of them are doing. They stand, I think, as good exemplars of the industry overall. The good news is that they will not have a negative net income for the year 2020, but they'll be essentially break even. And I think that's probably a good example for the industry as a whole. There's been a lot of pressure on portfolios, but I think the biggest pressure, we can just go get in the weeds a little bit, is liquidity. Because if you're having countries that are implementing moratoriums and borrowers don't have to pay, well, obviously that's not cash coming in to the MFIs. And a lot of them don't operate on huge liquidity buffers to be able to finance their operations for months at a time without having a steady inflow of cash. And even when there's not a moratorium, there have been huge amounts of voluntary or involuntary rescheduling of loans to give the micro borrowers the time they need to recover from this pandemic. So I think probably the biggest issue is liquidity. Allied to that are things like solvency and portfolio quality generally. But the swing we're now seeing to come back to a state of normalcy in operations, we are seeing across our entire portfolio. Also, I want to give a shout out to the international lenders. We're an international lender, we're also an equity investor. So other international lenders have joined us in basically giving forbearance agreements, handshake agreements, sometimes formal agreements, so that the normal maturities of debts at the MFI level have been rolled over to reflect the underlying cash flow stresses on the portfolios. So I hope that's not too much detail, but I think the overall look is that, sure, it's been a really hard year. And unlike the financial crisis, the pandemic has affected everybody, all up and down the economy. But at the end of the day, I still believe, and I think the results are starting to show, that these businesses that are at the heart of microfinance are going to survive.
Thank you, Brad, for the comments, and particularly for organizing your board meetings so that they refresh your mind prior to the panel. That was very kind of yours. Now shifting to Diane, and also as Brad was saying, we've seen the pandemic affect everybody, and in a number of ways, some not so good. I think many parents are about to kick their kids out of our homes. But other than that, we've all also digitized our lives more, right? So Diane, as an expert in digitization, how have you seen microfinance institutions and similar organizations and their attitudes evolve in this maybe digital push that we're all living?
Sure. Absolutely. I think if we can just take a step back and think about microfinance a little bit more holistically from the international finance corporation or international lenders or development banks, there's always this push versus pull strategy that always been kind of the thought about microfinance institutions. So this push strategy from IFC, other development banks for MFIs and SMEs towards digitization and the importance of that. But the problem is you have to have a very strong value proposition to entice the MFIs, these traditional banks, to move online, to adopt digital financial services. Because using cash merely is just more convenient and cheaper than mobile money. And it's really accepted everywhere. So IFC back in, if we were back in the mid 2020, which was such a crazy year, the COVID, actually, the pandemic really brought an opportunity for, I think, us to understand the need and the importance of digitization even more in the financial sector and across the other sectors. ISC did like a study for 140 plus MFIs and financial institutions to figure out what was their pain points after the lockdown. And basically they came back and said, the worry now is trying to stay abreast with all the digital products out there, and that they feel that digitization will be quintessential for the future of their business. So going back, they asked, how do you run a financial institution from home? How do people work from home? These traditional brick and mortar stores, basically, that are closed to clients in the most destitute areas of the world, how do you get them engaged, and how do you provide these types of products and services for them? So these traditional banks really had to take a step back to look at their back office, their policies and procedures, to think about a new, not even a new, to adopt a digital transformation strategy so that they can continue to serve their clients. So I think the attitude, initially from more of a push from these development banks as a push strategy, has become more of a pull strategy in terms of the traditional banks and these SMEs wanting these types of products.
Thank you. I think we might have all seen this cartoon where somebody was saying, who drove your digital strategies, the CEO, the CTO, or the coronavirus? And we all say the coronavirus, right? So that's maybe a bit of a silver lining, but also provides us with an opportunity to start shifting our gaze towards the future, right? As we promised at the beginning of the panel, microfinance started very local, doing credit, microcredit in a number of emerging markets, right? And now we've seen the industry globalize, get increasingly more digital, and essentially grow to $120 billion, which is remarkable, right? So Jennifer, coming back to you, you're very well placed making investments in emerging markets, but also domestically in the US. And you were reflecting with us the other day about how you see microfinance actually having a bright future in the US. And that highlights that convergence that perhaps low-income populations in the US are not that different from those in emerging markets. So could you share with us what you've seen and where you think that might go?
Yeah, absolutely. Yeah. And to your point, microfinance has often been thought of as emerging market conversation, but its need is just as, it's needed in the US as well. There are markets that are disconnected from traditional financial resources that are not served, and they need to be served. It offers a way to improve one's life, to access capital. And, I see it in kind of three steps in the US a little bit. One was the entry of Green America in 2008. They came and have established about 20 financial centers or more across the United States. They have put more than $1 billion to work, and primarily into the hands of women, and have really shown that there's a market here in the US, and a market that can be scaled and served. And an interesting note, if people would like, is they do have, even on their website, a randomized control trial that they did in 2019, just showing the impact of their work really having some correlation to improving lives. The impact of microfinance is sometimes questioned. And I think that randomized control trial is a really good data point to show the positive impact that financial inclusion, providing financial services, can have in one's life and one's economic improvements. So that was kind of one moment in time that I think is interesting. But you fast forward even to today with COVID, and what we have seen as the economy stalled a year ago and bottomed out through lockdowns, and the PPP program was initiated by the government, that there was an enormous part of our communities that were left behind, that small businesses, individual proprietors, businesses that have less than 20 people, that are often minority or women owned or in underserved communities, were just left out completely from those resources. Those resources often flowed through traditional banks. And those that had established banking relationships could easily walk into the bank or call their banker and access a PPP loan. But if you didn't have that relationship, you had a challenge to access that capital. So they were left behind. And it really showed where the financial plumbing was not complete in our communities in the United States. And what it also showed is that there is a network of unregulated banks, community development financial institutions, credit unions that are part of that plumbing, but they have been under-resourced for decades. And so the demand is much greater than the supply that they can provide. So I think we're understanding as a society more and more that we don't have enough plumbing, financial plumbing into community in our own communities, and we need to invest in that. Seeing signs of that through the Biden administration, seeing signs through that in how communities are responding and providing the capital that perhaps isn't coming from traditional sources at this moment in time.
Thank you. Very sobering. If the U.S. with all the wealth it has, cannot figure it out. But we will trust in the new administration to do well. So shifting now to Diane and taking it back in a way to the technology trends, right? One that we've seen is that, as you were pointing out before, Diane, there's increasing amounts of financial products that are now fully digital, right? And as any software, they like to escape the financial sector and go into the real economy sector, for lack of a better word. Can you elaborate a bit on that? How do you see that happening? And what is IFC's stance on that trend of embedded fintech?
Sure, absolutely. David, I think this is a large question, but I will say, it's this embedded finance or this embedded fintech idea, we're probably already using it that we may not even know. So I think it's already here. It's probably going to be embedded everywhere in the real, if you're, for lack of a better word, real economy, whether it's transportation, goods and services, etc. And from IFC, it's a really big topic now because we're seeing such great innovations from fintech companies as great add-ons to different companies and such. So if I can give a case example, a successful case, if you can think about Grab Taxi. Grab Taxi, for those who don't know, it started in Singapore in 2012, and it was a ride-sharing company. And now it's really expanded across all of Southeast Asia. And the company mainly focused on services for entrepreneurs and small businesses. And it recently announced that it's going to launch a slew of consumer products. So it's going to have micro investments, loans, health insurance, and pay for later programs. They had a joint venture with ZhongAn, an insurance company, to create a digital health marketplace for its drivers. So if you think about this idea of this embedded finance, it really is integrating the financial service into non-financial programs and really highlighting how this is just one area that they can just gain so much revenue stream. So for the insurance company, if you think about it like that, Grab, who started in Singapore, now all of Southeast Asia, they have over 180 million users across 300 cities. So insurance companies that are embedded into Grab will now have access to the entire user database. If we just go quickly back to what Jennifer mentioned about the US market and thinking about SMEs in the US market, I think if we're looking at from the digital standpoint, if you look at big tech companies, say Amazon, for an example, they're dealing with so many small and medium enterprises right now. They're even offering new loan products at their point of sale. So you can do buy now, pay later. So we really see a clear trend for these non-financial finance players really making a big push for a greater market share for consumer financial products. So I wouldn't say that they're directly competing with banks for such, but really it's to diversify their revenue stream and increase their customer lifetime value. in a sense. So that would be all the embedded finance that I could say probably about that area.
Thank you, Diane. I know I pushed you a bit on that question, but it's a very interesting one, and I would probably agree that they're not competing yet because there's so much more demand than supply that as long as you supply fairly, you're going to get some demand for your product, but maybe at some point they will compete. And it is going to be very interesting to see what sort of investments you're going to need into microfinance institutions to get up to, so they can get up to speed with fantastic tech-first organizations like Grab, right, globally. So shifting to the investment side and taking sort of almost the last question, I think, of the first part of the panel for you, Brad. For the longest time, impact investment assets under management have been growing exponentially. I looked at the Global Impact Investing Networks report, and I think they're doubling every 3 years or so, which is great, if you ask me, for the future of our kids and everything. Microfinance was probably the first real big asset class in emerging markets for impact investors, but now it's getting competition from other areas like energy access and others, right? Perhaps inclusive fintech, if you separate that from microfinance. How do you see that trend from your lens as a major investor, and what is DWM doing about it, right? That trend of both growth, but also diversification in types of asset classes.
Yeah. David, just a question. Are we finishing now with the fintech story, or can I say something about that before I address the other question?
Please. I think we have 5 more minutes before we go into Q&A with the audience, and I have a few more questions that I can ask, but please, you got the floor.
Well, I just want to give a somewhat contrarian view about fintech. Since there is so much, there's so much enthusiasm, there's so much activity happening, but my perspective is that we need to distinguish very clearly between the opportunity and the threat. Now, the opportunity in a microfinance perspective, I think, is more about digitization of activities, cutting operating expenses. That's the biggest hindrance to microfinance growth, is this great cost of administering all these hundreds of thousands of very tiny loans. And so digitization, fintech can do a great service to the microfinance industry by increasing productivity, taking a lot of steps out of the process. On the other hand, I think the growth in mobile lending, in algorithmic scoring, has been disastrous in some situations. And I think you have to look no further than Kenya to see the problems that have arisen there, where you have default rates on the mobile lending, which are 3 times what they are in bank lending. And you see now people who are defaulting on $2 loans that they got in their mobile phones. Their credit rating is now destroyed in the credit bureau because of this thing. It's a cascading effect. It's terrible. What does that mean? I think what it means, from the way I look at it, is that fintech is like, it's a hammer. It hits a lot of nails. And so you can't say fintech is good or bad. What you can say is, what are the uses you're going to put to it? If you're going to put to it increasing automation, productivity in very sound lending practices, fantastic. If you're going to use it to have an uncontrolled expansion into consumer lending for any purpose or no purpose whatsoever, 3% of all the mobile loans in Kenya are used for gambling. That is not a good use of the digital technology. So I just want to lay this out there, that let's not look at fintech as an unalloyed good. It's a tool which has to be carefully controlled and used for the benefit of all.
Thank you. Thanks for having a contrarian view. That's always helpful. And I think now, Shreyas, is it time to open the public Q&A, or?
Yes, so thank you, David. Thank you, panelists. So we can open up the conversation for audience questions. We have a few there already. So yeah, audience, please type your questions in the chat, and let's start with a few that we've already received. So the first one, so the panel touched upon the fact that there is a large opportunity upcoming in climate and sustainability. What are the other areas that you see emerging in microfinance?
Jen, Brad, you guys want to take it?
Well, David, I think this pertains maybe also to what you actually asked me. I didn't answer, which was the other kinds of products that can be allied with microfinance. So at the risk of talking too much, maybe just a couple points on that. Here again, I have a bit of a contrarian view. I think microfinance does very well at what microfinance does, which is driving funding for working capital, for short-term, for unsecured business prospects. Unfortunately, that still remains the very long pole in the tent. And we've experimented with a lot of other kinds of inclusive products. If you scale up from the microfinance to the SME sector, that more or less works. But going sideways into things like education, healthcare, housing, insurance, renewable energy, we actually haven't had a lot of success in that. And we can talk about each of those products and why they haven't had the same success in microfinance. And it's not to say that they're inviable, but I don't expect to see the same huge growth, the same kind of stable foundation of inclusive finance from these other products that you see in microfinance. Microfinance is to some degree a unique product.
Jen, yeah, go ahead.
No, I would just echo what Brad said. You know, our experience is very similar. We have invested in microfinance entities, like I articulated earlier, networks and intermediaries, so all across the globe for decades. And we have not seen great success in them expanding into other sectors, agriculture, aquaculture, whatever it might be. The operations of microfinance are very much tailored to provide the service they do. And I think that, you know, that is great because they're doing a great job doing what they're doing. So there's no knock on it. And what we're seeing is also fantastic, I think, is awareness that these complex challenges in our societies need multiple strategies to resolve. That, you know, access to capital, financial services was one element to support quality of life. You also need education, you also need healthcare, and they come together. And so this kind of collective collaboration and community is what I think we're recognizing and understanding the more that we're all deeply engaged in this work.
I'll take a quick answer as well. And I will bring up the concept of, first time in the panel, of pay as you go, particularly for energy access, which is not typically offered by microfinance institutions, but by different types of organizations that have to be perhaps too many things at once. They have to be an energy utility company and also a lender. But what these organizations offer with a really fintech product, fintech lease in a way, is a lot of flexibility on the product. Essentially, they put a solar panel on your roof, and that way you can recharge your feature phone and have a couple of lights and a radio going. And then you pay over 3 years, perhaps, the amount that the panel was worth and some profit, and then it's yours from there on. So there's been a number of them working out of Africa mostly, and it's microfinance in the sense that they're doing microloans, but they come from a different perspective. I don't think their portfolios are nearly as good as what you see in the MFI world, but I think it is a very convenient feature for their borrowers or lessors to be able to pay in a more flexible manner, as well as be able to offset some of their prior expenses with cheaper solar energy. So I think there is experimentation going on. Some of it will surely fail, but some of it might actually strike a different type of gold, right? And maybe the MFI should focus on microcredit, and others should focus with a different cost base and a different approach on different products, essentially. Diane, I don't know if there's anything you want to add there, or maybe we can shift to the next question.
I think the panelist has a kind of a broad full circle to everything. One thing I think, just going back to the question from the audience, is I think Shreyas was mentioning what other areas besides climate finance, or I think another area that you can see microfinance in. And going back to, I think, what Jennifer mentioned, you know, you got to think about it as financial inclusion. Think about the healthcare aspect, the literacy aspect, the education aspect. So I think if there's no one avenue, I think it's very comprehensive in which you can think about in terms of like meeting the SDG goals or sustainability in that sense.
And David, just to put a bow on this, one thing I would say as a practitioner, we're a lender, we're underwriting transactions across all these sectors and geographies. There's two cross-cutting themes that come across almost every transaction. One is gender lens investing, and that really acts as a opportunity and a de-risker in a lot of our transactions, and climate. And that can be a risk that we highlight in many of our transactions. And, you know, so those two elements are very cross-cutting and can both show opportunity and risk.
Very interesting.
Great. And
Shreyas, what do we do with next? Yeah.
Yes,
sorry.
Jen, you mentioned risk. So another question we have is, so what do you think are the biggest challenges facing microfinance in the next 3 to 5 years, and how best do you think we can address them?
That's a fun question. I bet you, Brad, you have great thoughts on this. So I almost am tempted to pass it to you, but I'll just put, two things out there. One is climate, which I have said now a few times, but I think this is a cross-cutting issue. It's not just microfinance that it's going to impact. It's going to impact a lot of our work, but all of us have a role to think about how to be aware of that risk and how to mitigate it through all the work we do. So I think that that is a global risk that we need to address. One that's coming on my screen, and Brad, I'll really pass it to you on this if you have anything to add, but is decentralized finance. That is something that's starting to emerge more and more, with the idea that that will intermediate some of the connection between capital and user of that capital. How that might scale and grow, I'm still wrapping my head around, but I'm starting to see that emerge as perhaps a threat, or you could say an advancement of the microfinance sector. To Brad's earlier point, this would be something that would in fact enormously reduce operating cost and create just a very much more efficient pathway from capital to person and community. But Brad, I'll pass it to you.
Thank you. Well, I think you're spot on with what you said. I think another aspect, though, which again, being somewhat contrarian, the biggest risk to microfinance, in my view, is microfinance, meaning that it's so successful right now in so many countries. There's a big risk of overlending. Some of us remember the Andhra Pradesh crisis in India a few years back, in which there was devastation of the microfinance industry, which was caused more or less directly by massive overlending and really abandonment of the core principles of the kind of fundamental social as well as economic principles that have underlay microfinance. Well, guess what? In India right now, overlending is again becoming a huge issue, despite all of the restrictions that the regulator, the RBI, put into place. It just happens. I mean, when you have an industry which is so well regarded, so successful, there need to be some kind of buffers in place to stop the kind of overlending, to stop the overflow of microfinance into consumer finance, which I talked about earlier in the Kenya case. Many people call that microfinance that's going on with Kenya mobile phones. It's not microfinance. So I think microfinance, to be able to flourish, needs to be very clear as to what it is at heart, how it operates, the things it should not be doing. And frankly, also, at the end of the day, microfinance is an imperfection in the banking system. If we had perfectly well-regulated banking systems and perfectly well-regulated economies such that everybody had equal opportunity, there wouldn't be a need for microfinance. We'd all have banking accounts. We'd all have employment and wouldn't be entrepreneurs, every one of us, because we had to be, because we couldn't find a job. And so I think that microfinance needs to, in order to flourish, make sure it stays close to its roots, doesn't get distracted by some of these other chimera of supposed advantages. Secondly, however, though, what you said about climate change, absolutely true. There are massive things happening that is outside the scope of microfinance ability to self-regulate. Just the final point I'll make is that the idea of peer-to-peer or taking out the middleman and making a more direct provision of capital to microfinance borrowers can be very productivity enhancing. But remember, there's this bond of trust that exists between the loan officer and the microfinance borrower. There's that culture that is necessary for a microfinance institution to be effective. And the danger is that if you automate too many of these steps and you lose that real personal bond that lies at the heart of the relationship, of the capacity and willingness to pay of the borrower, you really could be striking a blow at the heart of the model.
Yeah, I would agree with that. My only thought on distributed finance or decentralized finance, which is a very hot topic on the blockchain circles and is receiving lots of American, Chinese, European investments, is that it would do two things, right? To Jen's point, it is designed and as a technology, it lowers the costs. So it therefore raises access in general. And it is a technology that is built around trust. Or rather, it disposes of trust. It enables you to have trustless transactions. So I think we're all wrapping our heads trying to at least around what it means in the next decade. Is going to change a lot of things, and at least we do have a lot of very, very smart people doing a lot of work in that area. And then we'll see. I don't think it will substitute microfinance. I don't think it can imitate it, but it can offer an alternative that might be very good in many ways, right? Because it would not suffer from the fact that you need a branch, for example, that sort of thing. So there's a lot of hype still and a lot of promise around all the different flavors of fintech, and that we just have to work it out. And as you were saying, Brad, stay true to the root, which is really trying to help those that were born unlucky compared to those of us that were born lucky, right? That's kind of what we're trying to do here.
If I can just
Diane, sorry.
Sure, I was going to add one point. When Brad was talking about the basically microfinance emerged from the imperfections of the market. What's very interesting about that is from the IFC's perspective, you're making very customized products for this segment of the population. And I think if I have to bring in, my background, the digitization arm of it, and making one of the biggest parts of this is actually access to credit. Having that information and access to credit for these microfinance institutions or the SMEs that they deal with. So I think in terms of the question, going back to what Shreya said, one of the audience, where do you see microfinance going in the future? I think there's going to be this heavy push to figure out how they're going to be able to utilize the data that they have to understand their customers and their SMEs basically a little bit better. And I'm not going to say that there's going to be one model that fits all, but I think data will be a very big competitive advantage, a resource advantage to figure out more about your segment.
Yeah, well put.
And David, I think in the interest of time, let me hand over back to you for that final panel question.
Thanks so much, Shreya. So yeah, the final question we all would like to maybe take a pass on, or not pass, take a tag at, is how might people who are interested in joining this continued revolution, how could they come in and join, right? So I would imagine that one easy way is to go into the websites of the organizations sitting in the panel and see, their careers page. But for those who are either students at Columbia Business School or thinking of going to Columbia Business School, there is a way that we've had for a while. It's called Microlumbia. It's a nonprofit impact investment fund that some of us founded when we were in school a number of years ago, whose purpose really is to give students hands-on experiential learning while they're studying in the morning, and then they're acting as impact investors in the evening. Brad sat on our board as the first one who actually knew something about microfinance back when. But the organization has gone on to survive. We've been around for 12 years. We have worked with 350 Columbia Business School students. And I was asking the presidents right now to give us the update on the numbers. So there's been 350 students, of which 75 are currently working as impact investors, and a total of 120, 130 are working in the social sector. So I don't know what would have happened to these people if Microlumbia hadn't been around, of course. But I think we can claim that as part of our KPIs. And if you have that ability, I would suggest that you go and try to join Microlumbia. It's a great way to find a lot of like-minded individuals and to be exposed to the industry. So that would be my answer. Jen, Brad, Diane, any thoughts on how we could onboard more people into the industry? Because I'm sure we need them.
I guess I was the first to unmute. So the one advice I would give is that, and this is perhaps particular to the kind of segment that we're in, where it's a commercial return as well as social return segment. So the experience in hardcore finance is really useful to come into a business like ours. We find people all the time who've had time with Goldman Sachs, Morgan Stanley, and they want more out of life. And they're willing to give up the increased revenue personally that they would get from staying on Wall Street to come to a small firm like ours, which can't pay like Wall Street, full disclaimer. But you get a much more psychic income of using the skills that you've developed on Wall Street for a better social cause. On the other hand, we get people sometimes who are just so dedicated and so talented, but don't have that hardcore finance experience, and we have to turn them away. So I think if you want to work in inclusive finance, having those finance tools is very important.
If I can bounce off of Brad, not only to have those, I guess from my perspective, if I was to provide them advice, I think, starting as microcredit enterprises to microfinance, the evolution of microfinance to now financial inclusion, it includes so many different types of products and services. So when Brad mentioned, it's great to have a very strong financial background, I think add to that moving forward and thinking about how we will create products for customers, understanding your customers, and with that is all the data that is involved in that. So there's going to be a need to even understand we're going to have some type of digital skill or understanding of how to manipulate data, structure data, and play around with data. So I think that would be an addition on top of just having a lot of passion in this ESG space, sustainability space as a forefront.
Jane, any thoughts from you to close this question, or?
I'm muting, thank you. Only that, as Diane was saying, it covers such a broad swath of opportunity, microfinance, and then if you go up to financial inclusion, then if you go up to impact investing, then if you go up to responsible investing. So there's a lot of different ways to find a role. Even in our firm, we have a marketing department, a sales department, a finance department. So the opportunities are large. What I do think is there isn't as many formal on-ramps. So you do need to work, you do need to network, you do need to reach out. So I'm there, I'm sure others are there too. And I would encourage people to reach out if they're interested in this work. And find the on-ramps that really resonate with them.
Thank you very much. Shreyas, I think we're out of time, so maybe it's time to wrap up the panel.
Great.
And I just wanted to say,
yeah, Jen,
sorry.
Brad, Diane, and David, thank you very much, and thank you for the audience for joining us today. We'll be taking a brief coffee break now, returning to Zoom at 11:30 for a discussion on what we've learned, the best solutions to come out of COVID. And a quick reminder to my fellow Columbia MBA students in the audience today, please check in using the link provided in the chat box for your PPIL credit. So once again, thank you, David, thank you all the panelists, and thank you to the audience.
Thanks, everyone.
Thank you, Shreya.
Really fun.
Thanks, everybody. Have a great weekend.